All right. Good morning. Good morning, everyone. Good morning, John C. Gaisley and Paul Go Down. Paul Go Down. That's a cool name. Go Down. All right, guys. It's great to see some of you in here already saying hello. We got more people watching than what said hello. So if you want to put up your little marquee, I'll make you famous. All right. What we're going to do today is we're going to do the math. And I know it doesn't sound too exciting, but it kind of is. You got to add up your profits. And that's what we're going to do today. We're going to do a little bit of math. So we're going to pull up the spreadsheets, and I'll show you the spreadsheet right now we're going to be pulling up. All right. I got several of them. And this is the, let's see, it's popped up onto the wrong screen. Let me get that over here where it belongs. See if I can make it all work on one screen. There we go. All right. So that is what we're going to be looking at today. This is our normal portfolio. This is where we actually trade and make money and take this money and then we invest it over into the cash cow portfolio. Now, this is the one we're going to focus on. All right. And I want to focus on this portfolio because there's an error in the math. I was in class the other day and one of the students pointed out that I had an error in the math. And what's funny is it was only an error in a few places, which was really weird. In the same column, I had one error pointing at the right spot and one on the wrong spot. And I don't know how I did it right in some and wrong in the other, but it's fixed now. And if you want to download the new spreadsheet, you can. You can go get it out there on pitnews.com. For those of you who are subscribers, it's in your email. And you can get this spreadsheet. You can get all these spreadsheets. You can get this spreadsheet. You get this spreadsheet. You get this spreadsheet, this one, this one, this one, this one. You get all the spreadsheets. All right. So all you have to do is subscribe to Pitt News Magazine and you get the spreadsheets. Pitt News Magazine is 19. Right now it's on sale, 50% off. If you use our code 1995 for a whole year. So you get all these spreadsheets for $20. I used to just give the spreadsheets away for free as part of just coming to the YouTube class. But then I found out that people were using my spreadsheets on their other YouTube channels. And then I was like, oh, that's not very cool. So I put it behind a paywall. So you have to be a subscriber to Pitt News Magazine over at pitnews.com. And it's $19.95 a year, and you can have all these spreadsheets. All right. I've spent hundreds of hours working on these things. So I think it's worth it. It's worth it. All right, so that's your spreadsheets that you get, but we're going to kind of come back to this in a minute. The thing I want to do first is I want to come over and I want to look at the news, and I want to just check out and see what the news is doing. Let's pull that up real quick. And then we're going to look at our portfolio real quick, and then we're going to go over and look at the mathematics of the spreadsheets. I know it's not too exciting, but I'm going to show you how to fix it, how to work it, what all the concepts are, how I designed it so you can do it too. All right. So we'll just play with the spreadsheet today. All right. First thing we want to do is look at our news. And there's not any big impact news. If I put that on twos, it just completely goes away for today, Monday. And today is Monday, the 10th of February. And we got Fed Hammock speaking. He sounds like a lazy guy. I'm so funny. And that's not till tomorrow, Tuesday at 6:50, Fed Hammock. And then we've got at 8 o'clock, we have Chair Powell testimony, and that should move the market, depending on what he says. And he's not a very friendly guy to the administration. So he's going to say something that's going to tank the market. So watch that. Be careful. All right. Fed Bowman, Fed William, they'll follow up with let's tank the market tomorrow. So tomorrow will be a big down day. Let's make sure we have our our hedges put on for tomorrow, just in case those guys, pull a boner out of their pants and wave it around. All right. So that's what happens when you got a Fed chair that doesn't like the administration. And we know that because he said that he doesn't like Trump says he wants to kick him out. Fed Chair Powell. He wants him out of there. He doesn't like him. So we know that. And that's the nature of the political beast right there. So let's see what happens tomorrow. Make sure we get one day ahead. So let's make sure we have at least get our hedges in there in case he says something stupid. All right. So that's all we got going. We got nothing today. So if we come back to one, we got all these things. Oh, now the dumb thing, this piece of crap. I hate it when it does that. Clear all these. States. It's the only one I want. Save. All right. Impact United States. 9 a.m. Consumer inflation expectations, and that's in an hour. Not really meant to going to move the market much. It's a single impact inflation, though. You'd think that would move the market a little bit more, but they've got that marked down, clear down to one impact. Forecast is 3.1. Previous was 3. We're just going to see what that's consumer inflation. I guess that's not the I don't know. I don't know why that's not a bigger impact. And then we got the 3 and 6 month auctions. That's no big deal. But that is interesting. U.S. consumer inflation expectations for the year ahead remained unchanged at 3 in December 24, the same as November. Expectations for food prices rose to 0.2. I don't know why this isn't a bigger impact. Years ahead, expectations dropped by 0.7 percentage point for gas. This is a big deal to retail traders. I mean, this is a big deal. This is a big deal. How come they have it on such a low deal? Low deal. I don't know. All right, 9 o'clock today, we find out if eggs go up or down. All right, let's get rid of that. Let's move away from there for a second. We got to keep that, though, because we got to come and look at some of this other stuff. So we'll keep that in there. All right, let's go look at our portfolio. We don't have a whole lot on right now. We took a lot of it off. We took the profits off. We had a couple of big losers, and it's because I didn't hedge them properly. And that was my mistake. Learn from my errors. Let's pull up our spreadsheet. And we'll go take a look at that. Oh, there it is. We're going to go take a look at that. So last week, January, this is the January, and we didn't trade very much because we did lots of lecturing and talking about other things. But the few trades we did take, we did okay on. We had closed out the month. We had to close out some losers for the month, and that kind of was a bite in the ass. But we ended up with a running profit loss of about $2,800. That comes up here for January. And our monthly goal was 11,000, and we only made 28. So we fell short of our goal of 8,200. So that you can see what happened in January. In February, we've still not been doing very good over here. We've not been paying a close enough attention to our trading portfolio, and been doing more with the UBI stuff. And so you can see we had one little trading day here where in February we made a little bit of money, and then we had to close out some winners and some losers, and just cleaned out the portfolio because we had made some mistakes in there. We didn't hedge and the markets fell. So we took a $2,300 hit on that one right there. And right now we're still sitting on some recovery. We're trying to get some of these to move in our favor. This is Caterpillar, and we got a sold put down here just to collect some premium. We've received $930. Of course, whenever you sell the option, you also owe the $930. So it's like that little T-square, right, in accounting. You all took accounting 101, and you got the little T-square. And so on the left is your debits, and one side is your credits. And so when you sell a premium, when you sell an option like this, they credit you $930, but you also owe $930 on the debit side. And the only way that debit becomes a credit and that you don't owe that debit is time. You have to have time decay in your favor. And we've just barely put these on. So we got lots of time still, which is why we haven't received any. That's why we're still not making a whole lot of money on this thing. So the time has to decay all the way to that purple line, and the market has to stay above that red line all the way to that purple line to get our full $930 on this thing. Now, if it falls down there and touches that purple line underneath the red line, we'll get assigned some shares. We'll get assigned some shares at whatever price that it touches that purple line on underneath the red line. So let's say if it touches it way down here and we get assigned the shares, well, we get assigned the shares at the red line price. So that would show a loss. We'd get our $930. We get that no matter what, but our shares would then show a $5,695 loss. All right. So that's how this game's played. Nothing's free in this world, right? Of course, if it came down here and it only went to this point and touched that purple line underneath that red line to that level, that'd only be a $632 loss, but you would have made $930. You still have the shares. The shares can still go up and make you money. Not that the shares can't go up from here, too. They certainly can. They just have to go up a lot further to get back to break even. So that's the name of this selling naked puts. All right. And then you got to have the cash in your account to cover that. If you're going to put that on, you got to have the cash in here. So we got the cash sitting over here. We don't have to put it into the market. We just received the $930 against the 100 shares of premium that we'd have to have in here to pay to purchase 100 shares. So that is how we sell naked puts. Okay. So here's Caterpillar. So really when you do it, you want the market to go up. You're putting in a long position when you do that. And Google Alphabet. This is one that's given us a pain in the butt. We took a we put in some we sold an option here. That's what happened. And then we got assigned our 100 shares and then the market went up and we were happy. And then we didn't hedge it and we didn't put a stop in. That was the mistake that we made right there. We hedged it. We didn't hedge it. We didn't stop it. We didn't pay a close. I'm sorry. I'm trying to get this thing to enlarge here for you. How can I do this? There we go. So I'm trying to. What happened is we got assigned our shares, and then we didn't pay attention. This is a demo account for the YouTube channel, and so sometimes I don't come in here and pay attention to it because we're not working on it, right? So a couple days will go by, 3 or 4 days, and we're just not in here looking at it because we're doing other things. Maybe we're day trading in another platform, and we're just not doing something, and we didn't hedge that. So we didn't have a stop order put in there and that thing flushed down. So that's why we're down $1,000. And so by the time I saw it, and I was like, oh, we got assigned 100 shares and we didn't pay attention to this market. We got to pay closer attention to our account. This is a lab for our university, and so we learn in here, and we do all kinds of things in this lab to try and learn. And that's one of the things we just learned. We got to pay more close attention to our position. So if we get assigned some shares, we got to put our stop order in and make sure that we get it hedged. So if the market flushes, we don't lose a whole bunch of money. So what we did here, I'm losing my voice. Hold on a second. So what we did here is we came in after the fact and just bought a put option just in case the market falls. Now we had to pay $630 for that put option, and then the market didn't fall. Looks like it's falling a little bit today. It'll probably fall tomorrow after the Fed speaks. So that'll just protect us to the downside and stop our losses. Now, not totally because, well, we got two of them in there. So we got a delta of, we paid $630 for two put options with a delta of 1.0. So that'll protect us to the downside as long as that thing keeps falling. If it starts to go up, well, then we start losing money here and making money here. So we'll have to watch that hedge close because if it turns and makes first candle to break a new high, we'll get rid of that hedge. I'm losing my voice. I can't even talk. All right, so that's what's going on here on Google. And that came in late. I know, we're late on that one. Microsoft, we did the same thing. We sold this put here, we were doing well, and then suddenly it just flushed like a toilet, and we didn't put that on until the end of the day of that big flush. So that's our hedge right there. And the hedge is, let's go see what we've got going here. We'll come and just look at the chart alone. So the hedge is doing okay. It's up 284, 212. We're down 200 on the sold put. So, and that's not even too bad. The sold puts at 200. It wouldn't hurt us to get a few shares down in here as long as it doesn't drop too far. It looks like it's getting ready to drop again. First candle break a new high. Lots of bottoming, topping tails. That's an indecision bar, but it looks like it's headed back down again. Well, we got our hedge on. We could hang on to this. We got 11 days until we get our $660, but we're down 192 right now. So I don't know. We'll see what happens. None of these markets are very happy. We are down here at the lower region of that delta cone of probability, which is what this is here. This yellow line, red line in the middle, and yellow line out here. This is the delta cone of probability on here. So you might see it as the Fibonacci ruler. Some of you guys are familiar with Fibonacci. That's what Fibonacci is. It's a delta cone of probability. The probability is that the market's going to return to the one standard deviation, which is the center right here, between 61.8, 38.2, and 50%. That's your Fibonacci ruler, but that's why Fibonacci works, because it's the delta cone of probability. So if you're not familiar with that, you can search that. I don't know if you can search up delta cone of probability because that's my name for it. You want the real name for it? Here, let me go find it for you real quick. The real name for that is, if you come over here, let's see, delta cone of probability. Let's get that up here for you real quick. And then we'll go, once we're done with this, looking at what we've got here, we'll go We'll go do some math. We'll go look at our spreadsheet. I know that's what you're all waiting for. You can't wait to go look at the spreadsheet. So I want to show you the delta cone of probability. Where is it? There it is. And that's why Fibonacci rulers work. All right. We always say, the market's going to go back to 50% of the last major move. The real word for it is the 68, 95, 99.7 empirical data distribution rule. But because that's such a big, long, nasty name, I just renamed it delta cone of probability. All right. Approximately 68.2% of the time, the market stays within one standard deviation of the mean, which is that centerpiece right there. All right, between 61.8, 38.2. Around 94.4% of the time falls two standard deviations. That's out here. And then 97.7 falls within three standard deviations. Now, to reword that, I kind of reworded it. Fibonacci ruler measures retracements and extension levels to identify mean revision points. Bollinger Bands visualizes volatility and potential reversal zones around the mean, and the RAF channel detects linear trends and highlights deviation for potential reversal opportunities. So there's a lot of tools that we use, including like MACD, stochastics, RSI. A lot of these tools are designed around that cone of probability, that 68, 95, 99.7 empirical data distribution rule. All right. So entry points, traders look for deviations from the mean, one standard to two standard deviations, potential entry points for mean revision trades. Understanding revision zones helps in setting stop losses and profit targets. Option traders use mean revision to write calls and or puts in the center of the one standard deviation range. The VWAP taking advantage of statistical averages, advantage that price stays within the range approximately 68.2% of the time. So that is your Fibonacci ruler, and that's the math behind it. That's why it works. All right. So that's what this is. I just drew this in here. It's called the Donchian channel, and I just put it at 100, and it measures that for you, so you don't have to constantly be drawing your Fibonacci ruler across there. And we are at the bottom. We're down here at the low end of that thing. So if markets move in waves, we generally get one up for every down, right? So it doesn't mean a market can't just tank and just keep on going. It can't, but it can. But, right here, we're kind of expecting it to roll out the bottom and go back up. It's at least up to the halfway point. So if that's the case, we should be okay. And that would be okay if we had it do that. This is Microsoft. We're just looking for it to bounce off this lower region down here, which is why we put that order in there. And I was looking for it to I thought it might stay up there a little bit and go up into the next Darvas box, which is above this high, break the previous high and keep going. But nonetheless, that's where we're at. All right. And that's what we're looking for this market to do. We're up 271 on it. MSTR, we're down a little bit. We got the hedge put on. We did the same thing. We got the sold put here, and then we put the hedge on. The hedge isn't making us any money right now. The sold put's the one making the money. Oh, we sold a call. So that's our covered call making money. The hedge is down 43, but we're down $805 on the. Oh, let's see. No, that's the call and the put. That is the hedge down there. The hedge is down 850. Is that what we're doing here? We bought a call and we bought a put. Which one of these is this? 340 and 340. Oh, we bought them right on top of each other. Oh, this is a synthetic long. So, this is okay. All right, I see what we're doing here. So this is a synthetic long. So this is a long position. It's a free trade because we bought and sold on the same thing. So it didn't cost us anything, but we're down $800 on it. And then we've got a covered call up here, which is up $173 because the market isn't rallying. And then this is just a hedge. This is just a put option. We just bought one put option in case the market keeps coming down. So that put option is down $51. That's just our hedge. This 807 is the one that's hurting us because of the market's not going up, and we bought long call, basically, is what that is. But we didn't pay anything for it. It says we paid $7,000 for it. But the market value is $6,400. So we received $6,390 and we paid $7,025. So that's the difference between those two. It's just not going anywhere. But we just did that a couple of days ago. We need the market to rise. MicroStrategies. This is basically Bitcoin. So we're looking for Bitcoin to go up. So that's what this is. It's all on Bitcoin. Bitcoin's not going up, so we're down $500. All right, AT&T. We just bought AT&T and went long. We got to stop at break even. The market's taken off. It's going higher. And I did that just so we could watch the dividends, because AT&T gives you dividends. And we're up $50. We'll wait and see what that. We need to put this into our spreadsheet so we can see what the dividends are paid out, because it's for being a stock and dividends, it's really high dividends. But for what we're used to seeing in dividends, because we do the options dividends, it's piddly. Why bother money? All right, so Texas Instruments, we sold the put down here. It says we're down $500. We paid what? We bought two puts? Buy two puts. Why do we buy two puts there? Man, that's a stupid place to buy two puts. Well, maybe we thought that this was going to come down with an ABC. I don't know why we did that. There, and then down. That might have been the projection we were looking at, thinking that that thing was going to come down. We must have had a long position in here that we took off. I don't know. I bet that's what happened, because last week I took a bunch of profitable trades off to help cover some of the losses. And now we got this little short position sitting here. Well, the market looks like it might be flushing. That's bearish on that Texas Instruments. Who knows? But we're at the very bottom of the cone of probability. I'd be going back down into another bottom, a downward trend Darvas box. The whole market's sliding down, man. The whole market is sliding down. ExxonMobil. Oh, well, energy prices are going up. We sold a put right here. That should be profitable. It is $66. It's a wimpy one. $194 is all it is. We just did one, right? Looks like we timed that one pretty good. I mean, that was the absolute bottom right there. And we put it on at this bottom here. So that's okay. We'll just hang on to that one. That's where we sit with our portfolio. We need to go through and add some more things in there. We need to actually do some trading over here, because I got so few things on, and we got a couple of downers here, Debbie Downers. So we need to get some stuff going on here, because we've been focusing too much on our cash cow portfolio. So let's come and see what we've got going here, because I think we got paid. And I can't remember if I put the money in here or not yet. It's 210. I think we got paid in here. So we have to go look and see. So this is our venture capitalist portfolio, our UBI. We're going to go through the math, all right? Because I'm going to show you we had an error in here. And so for those of you who are following along and you're using this spreadsheet, I got to show you where the error is in the math, all right? But let's start in the very first. So this first section right here, let's talk about what this section is and how this works. It's very simple. We're going to come in here, and these columns right here, kind of funny looking, those retrieve from, if you have Microsoft 365, which is a subscription service, you have to pay for Microsoft. And if you have that service where you have Microsoft 365, which is what's giving you the Excel spreadsheet, right? Then this is how you get data retrieval. So let me show you how that works. I'm going to come over here to, I'm not going to screw it up in here because I don't want to screw up the spreadsheet. I'm just going to come over to a new spreadsheet, and I'm going to show you how to do that. So if you want to get a stock symbol, you put your little cursor in here, and you come in and you say, I'm going to put AAPL. So you put your Apple symbol in there, and then you come over to data, and you say, this is a stock, and you just click this little button right here. And that turns it into a stock. And then what it does, it goes out and it retrieves the data. All right. So we're going to come over here. We're going to say it's Apple. Select that one. And we're going to come over here now. And we're going to, let's see, that should fill in a little bit more. Okay. So we're going to come over here, and we want what price do we want? So we're going to come in here, and we're going to say, I want, it's supposed to give me a, how come that's not giving me my, oh, there it is. I had to hit select. Did you see that? Okay, let's do it again. This is MSFT. All right, so then I go like this. I tell it it's a stock. over here, you have to hit select. You can't just click it up here. You got to hit the little select thing. So you hit select, and that goes out and it retrieves the data. Now, see this little icon right there? If you click that little icon, it says insert data, extract data to the cell. So this, you come in here, you click that, and then they give you this list of all the things you can put in here. So you can slide down here, you can get the beta, the change, the currency, the description, the employees, industry, all kinds of stuff in here. And one of the things they don't have in this list, the ding dongs, they don't have dividends. All right. So you have to go do the dividends manually, because even though you pay a subscription to get all this data and they get all this great stuff, they can even tell you the number of employees that the company has and have that in your table, but they don't have dividends. They got the PE ratio. They got the price is the one we usually want, right? They got the volume. They got the year incorporated. They got all kinds of stuff in here. Number of employees, the change, the beta, the 52-week low and high, but they don't have the dividends. Stupid. All right. Even Microsoft. All right. Price. So we want the price. So there's the price. And that's how you get the price. Now, if you want to, and it will go out and it'll check every time you open the spreadsheet, or I don't know how often they check it. They don't seem to check it very often. So they have this little refresh all button here. If you hit that, that goes out and it forces it to retrieve the data. All right. So we can do the same thing here. We're going to come in and we're going to say on this one, we want the price, and we put that in there and it gives you the price right there. So that's retrieving the current market price for Apple, and that's how you get it. You hit refresh and it'll update your tables, and then you can come over here to home and you can go auto sum and add those together and hit enter, and there you go. You got yourself you can grab those and move them, boop, just like that. Now you got yourself a total of Apple and Microsoft combined, okay? And then you can do all kinds of math with that. So that's how you get or retrieve that data. Now, I don't know if Google Sheets, I haven't tried it, and I have Excel. I don't use Google Sheets. So I don't know if that's a free service on Google Sheets, because Google Sheets are free. And if you can retrieve data for free, we should go try it, because that might be something you can do. I just don't know the answer to that, because I'm an Excel guy. All right, so let's come back over, and we'll just keep that sheet here just in case we want to play on it again. So now we come back over. So that's how this is. So this is just your stock, your symbol. I just typed that in. See, it's just typed in. And then your current share price. That's pulled from that thing we just did. I just showed you how to get the current share price. And then this is the dividend most recent. Now I got notes up here that tell you all this stuff. This is the most recent dividend amount. I get my dividend numbers from FinViz. I have no idea if they're correct, but they seem to be. Remember, they change all the time from month to month or week to week. So dividends don't generally change, or regular dividends from normal companies don't often change very often. So let's go look at that. And since we're talking about it, we have to go look at it. We're going to go into detail with this stuff. Let's go pull up our dividend thing. All right, so let's go. And here's our symbol, and we're going to pull up AT&T. All right, so just pull up T. And if you look right here, see, it's 27.8 per dividend. This one here, 27.8. This one here, 27.8. So it's dividends generally stay pretty consistent when you're just doing a stock. Now, every year they'll adjust them, and that's how you get these dividends that end up on a list that's like, oh, you know, this company raised their dividends every year for the last 25 years. And you can get a list of stocks that'll do that. Doesn't mean a whole lot. They might go from 0.278 to 0.279. Oh, we're on the list. So anyway, but that's how you get your dividends, and you see that they're pretty consistent. But when we go to these funds that use, let's say, for example, let's just go Tesla, TSLY. We use these funds like the Yield Max funds that give you dividends every month, and they use options to give you the dividends. You'll notice that they're not the same every month. They usually try to stay pretty close, but they're not the same. See, 717, this is 1.28 and 0.92. That's a bonus. So you got 1.129 and 0.092. You have to add those two together. So they did well that month, so they gave you a little bonus. And then here's another bonus. So they got 55 cents and a little bonus of 0.045. And then they got, see how they're different every month. So they change. because they're not like a typical dividend. What they are is they're giving you the profit from trading options. And so that's how this is a little bit different than a dividend. And these guys are not giving you dividends, but they don't have any other way to call it because they're trying to fit their model inside of the model of the stock market. So every month when they dish out their profits to you from trading options, they put it into the dividends. So people are very confused about that. You'll see that all over the internet. Oh, these dividends change. Oh, this yield max sucks. Oh, yeah. It's just they don't understand. They don't understand how this works. These guys are having to put their business model into a business model that already exists. And to do that, they distribute their profits to you from trading through the dividend system. And that's how you get it. So it's not really dividends. It's distributions of the profits. That's the mechanism that they have available to them to give you the money. And so that's the mechanism that it shows up in the system. All right. That's why it always shows that if you're trading these things in your funds, that you're not making any money, because the old traditional system of tracking doesn't accommodate what these guys are doing by making profit distributions through the dividend system. So it always shows you as this stock sucks. And so we've talked about that in class at the university, right? So that's how I mention it here just a little bit. If you want to know more about that, this month's version of Pitt News Magazine is just rocking and rolling. It's got like 4 articles in there about how these yield max funds work. And if you don't have that, man alive, I really think you should get it. It's one of the most important things if you're going to try to trade for dividends and UBI, universal basic income. You got to read that Pitt News Magazine, because it's just you just got to do it. You got to do it, guys. You just got to do it. What's Pitt News Magazine? Well, I'm glad you asked. Right now, I think that'll give us just 1 minute to give me a break to drink some more water while you listen to Pitt News Magazine and learn a little bit about how you can get a copy of Pitt News Magazine. And then I'll be right back and we'll continue the math of the spreadsheet. How's that?
Hey everyone, it's Claire here. Are you ready to take your trading knowledge to the next level? Welcome to Pitt News Magazine, your trusted source for trading intelligence. Whether you're a seasoned trader or just starting out, this magazine delivers the insights you need to stay ahead of the market. Featuring articles from experts like Dr. Scott Brown, Aidan Gray, myself, and of course Mr. Lan Turner. Pitt News brings you exclusive strategies, deep dives into market psychology, and powerful trading techniques. Find out about the exponential power of growth, seasonal trading secrets, and even Lan's latest wild eye, crazy eye iron butterfly strategy. Each issue is packed with expert trading strategies, top stock picks, key seasonal trading insights, and comprehensive analysis of commodity futures and ETFs. You'll also find tips on technical analysis, option strategies, and much more. No matter your trading interests, we've got you covered. And the best part? You can learn your way. Listen to each recorded article, read the full in-depth lessons, or watch our video breakdowns. It's trading education on your terms. Right now, we're offering a special deal. Get your first full year of Pitt News for only $19.97. That's 50% off the regular price. 12 issues of powerful trading insights, backed by our 100% satisfaction guarantee. So, don't miss out on this limited time offer. Head to pittnews.com and subscribe today. Empower yourself, enrich your trading strategies, and stay informed with Pitt News Magazine. Trading intelligence right at your fingertips. Okay, let's get back to Mr. Turner. Thanks for sticking with me.
All right. So there's where you can get a whole bunch of treasure trove of great information. And we just use Pitt News Magazine to highlight, and write articles about the things that we teach here in these classes. So it's our follow-up. It's our follow-up stuff. All right, let's get back to the spreadsheet. We're going to come back over here. So that's our current market value. That's how we got that. The dividends most recent. Now, if you'll notice how I do the math on this is I like to see not just the most recent dividend, because they change all the time, because we're tracking these YMAX funds, right? And so I do up here in the math formula, you can see I take the most recent, and in this case I've done 4, and it's kind of based on the trend of the market. The way I do this, it's just the way I do it. All right, so I'm going to show you how I do it and why all these numbers are up here the way they are. So if we come over to this one here is mag 7. All right, so we're going to go to YMAG again. We're going to pop over here, we're going to pull up YMAG, And why do you have to do all this stuff, Lan? Why can't you just look at it in your trading application? Well, because I just told you the trading application doesn't track it properly. You're trying to put a model of how the yield max company operates into an old system that wasn't designed to do this. And so it doesn't track it properly. So that's why you need the spreadsheet to really understand what's going on with YMAX. YMAX does things that are outside of the realm of normalcy. All right. And so they have to put their model into or fit it into the model that's available to them. And what's available to them is the old fashioned model of doing this stuff. And they never really thought about accommodating a company like Yield Max because they just didn't do it right. Yield Max only been around for 2 years. So they have to do it through the dividend system. And it works okay. I mean, it's fine. It's just that in your trading applications and in your little apps and stuff that you use to track your trades, it leaves out the most important numbers. All right. So because it's never had to use those numbers before. But it's very key and very important when you're using yield max funds that you track those numbers. That's why we need these spreadsheets. All right, so we're going to come over here and the dividends most recent. And again, you can see I've got 4 of them in here. I got this one and I'm just adding them together. So I'm adding them together and then I divide them by the number that I put in there. I got 4 of them, so I divide it by 4, which gives me an average. So my average most recent dividends is what I'm getting right here, okay? So, and I hate Excel sometimes because you click in there and then it gets all freaked out and thinks you're trying to change the formula. And if you're like, no, I don't want to change the formula, it forces you to change the formula. All right, so we're going to come back here and we're going to go to YMAG. And what I've done, the most recent one is 0.186. All right, so let's go update our spreadsheet with 0.186. And we're going to come over here and we're going to go 0.186. And we're just going to add it in there. 0.186. Oh, we got to add it though. Got to put a little plus sign in there. And then if I want to keep that, I can just say, oh, it's divided by 5 now. And I've added that new most recent dividend to the average of the last 5 dividends. So that gives me kind of an average of the dividends since they change. And that's what I got going there. So I need to go down every time I get a new dividend. I need to go down and update that sheet. Now, if I want to leave it off, I can drop off, however many I want. I can drop off this one and add another one and keep it at 4. But see that stupid Excel. I don't want to change that, you dumb nincompoop. Now look, it screwed up my whole dumb system. You idiot. So I don't know. For now, I'll just do it like this. And we got 3 of them in there now. There, you happy? You ding dong. Stupid thing. Now it's screwed up. Divided by 3. Point. Oh, crap. I wonder if I can. And look, it doesn't let me go back. And that's not right. I don't think that's right. Maybe it is. But now it got rid of my. There. I want that one. Okay. Now, don't mess with my formulas, you dumb thing. All right. So there's our formula right there. If you put it over there, you have to be careful you don't screw up the formula. As soon as you put your cursor in there, it forces you to make some change. You have to enter. So there we go. We're 0.5. We added 0.186 and we got that. Oh, and I just did it again. Doggone it. And I got that from over here. So if you look in here, 0.19, that should be 0.19. Oh, I'm in the wrong table. 0.19. 186. Yield max. Don't do that to me. It tries to do so many things for you that it screws up the stuff. So we got 186, we got 19, we got 10, and this is YMAG. So I should take those last 4. You can go back further if you want to, but that's 1 month. All right. So let's just redo it because it looks like it's not right. It's 0.18, and it's whether you go forward or backwards, I guess, is Sometimes I go forward, sometimes I go back. 0.19, 0.10, 0.05. That's the reconciliation. See, it's a lot lower. They do a reconciliation for the month. And so now we come back over to this spreadsheet. I'm going to redo this. So we'll go forward. 0.186 plus 0.19 plus 0.10 plus 0.05. All right. And we're going to divide that by, we only did 4 of them. Divide it by 4, and we're going to get an average. So that's the average of our dividends. So 13 cents. 13 cents per share. And that ends up being a dividend yield of 38%. So you're getting 38% return on your money, basically, is what this is saying. On a weekly basis, it pays out. The weekly is frequency. That's an annual dividend. All right. So, and then this is your weekly, and then this is payday is on Friday. So it pays out every Friday. You can see the dividends right here, paying out every Friday. So that's what the spreadsheet's telling you. So how often does it come out? Weekly, every Friday. And our yield, I have this kind of long formula in here. You can see if it's a weekly payout, then we're going to do this math. If it's a monthly payout, then we're going to do this math. And then if it's a quarterly payout, we do this math. So we can do all of them. You can just put in there, you have to type in there, and it looks at the formula. If F6 is weekly, then do this one. And so that's the one we're doing. And then we take the math based on our current value, our dividends, we do the math, and it gives us the yield. All right. So the yield is important because if you just look at the dividends and you say, well, this dividend is 13, well, this dividend is 129. Yes, a higher dividend is nice, but when they're close, it's like, how do you know between like this one here and this one? So if you do the yield, it's a lot better. And then I like to do the average of the dividends so I can get more of an average number of the yield. So the yield, this one here, see, Tesla gives you a 98% yield. It gives you $1 on the dividend, but this one here is $1.29 on the dividend, but the yield is only 74. So even though it's got a higher dividend, you might think it's going to give you a higher yield, but it doesn't. Why? Because the share price is higher. All right. The share price of NVIDIA is $20, whereas Tesla is only $12. So you have a dividend of $1 that gives you a yield of 98, whereas a dividend of $1.29 per share gives you a yield of 74 because the share price is higher. See that? So that's your dividend yield. That's why this is more important number than just tracking the dividends themselves. So the yield tells you which ones of these you want to be in. And that's why we have a calculator. So if you come over here to your UBI calculator, actually this one here, you can see all of them are listed. Everything's listed in there. And so now we can see the yields, and we can come down, we can see which ones have the highest yields. All right, so there, our highest one is Verizon. Now this is from normal stocks. These are not the yield max stocks. These are traditional dividend calculators. See that? So these are just 35 or 30 of the top dividends from normal companies, not companies that dividend companies. And the highest you get is from Verizon at 6.78%. AT&T is always touted as one of the best out there, and it is at second place at 4.49%. So that's per year. You get 4.49% per year annualized for whatever money you put in there. You can almost get that at Cash Valley Bank. Not quite, but you could probably get a CD at Cash Valley Bank very close to that. So however much money you put into AT&T, you put your money in there, and then they're going to give you a 4.49% return on it every year, and it's paid quarterly. Just almost like a CD at the bank. The difference is that you have the NAV, net asset value of AT&T going up and down, right? In a CD, you get the 4.49%, but you don't get the net asset value going up and down, which in a bad year could be better just to have a CD paying you 5%, 4% return, because the NAV goes down, you lose a whole lot more than what you make. And so that's why people buy CDs. Like, why would I buy a CD? Well, because you can get 4.449% over a year's period of time, but you don't have to worry about the net asset value of the stock going up and down. And if you're just looking at dividends, that's about as good as the dividends get. If you don't get good NAV, if you don't have good rising prices, the dividend, you just as well be in a CD, right, at the bank. And a lot of these don't even have as good as a CD. You can get right now you can get pretty close to 5% in some CDs right now. 4.5, 5%, about as good as you're going to get. But look at these. If you go into Nike, you only get 2.5%. You go into 3M, you get 1.8. You go into Apple, POS Apple, you get a 0.44. You don't even get a 0.5% return on their dividends. So it better damn well go up in money, because that's the only thing you're getting any money off of. You're not getting any returns. So then we go over to YMAX. All right. So this is normal traditional dividends, dividend yield. Now we're going to go to the YMAX list. Now look at this. YieldMax AI, they're giving you 117. Are you going to go down to Cash Valley Bank and say, I would like 117, please? No, they're going to tell you to go pound red sand. All right. There's 100 on Snow. There's 111 on Tesla. There's 82 on Coin, 85. This is your dividend yield, annualized dividend yield. You come down here to some of these that are a little bit smaller that don't have as much volatility, 34%. Look, the lowest one is 19, which is 4 times bigger than what you can get a CD at the bank. But the problem with that is you're like, well, how are they doing that? Well, they're not just traditional dividends. They're actually trading options. And these options make money by trading options, and they distribute that as a distribution, not as a dividend, but it comes out through the dividend system, because that's all they got available to give it to you as, right? They can't say, oh, this is a distribution of money. They have to give it to you as a dividend. So they give it to you as a dividend. But they also are giving you part of your own money back. That's the ROCC, right? ROC is your cash and capital. So they're also giving you part of your own money back. So the way it works is, if you go over, let me draw a little chart for you. Actually, let me show you. I can show you right here on the screen what's happening and why these are so high. Are we back? Stupid internet. So, so that also is part of your net asset value. All right, you have to realize that's what it's doing. So let's go over to a chart and I'll show you why these numbers are so high, and why these numbers over here, why these are so low. Because these numbers don't include net asset value, and these numbers do include net asset value. Okay, let me show you how it works. So we're going to come over here and I'm going to do a standard comparison performance. So we'll come in here to performance and we're going to do TSLY versus TSLA. And look at the difference. Okay, so this is TSLA right here, Tesla, and this is TSLY, Tesla from YieldMax. And you look at that and you're like, why in the heck would I ever put any money into TSLY? What a piece of crap chart that is. I don't want to trade that. I'm not putting my money in there. Right? And if you go out and listen to other guys on the YouTubes, that's what they're going to tell you. Oh, you can't make any money trading. Oh, this is a crappy thing. Oh my gosh, why would I ever do that? Well, the reason that you do that is because they're giving you back this money here. See, they put that money right there. See this money right here? The difference between Tesla and Tesla is coming out in a dividend. That's why the dividend, not really being a dividend, is a distribution of wealth. Okay, so that's for people who want to have an income. They want to live off of their stocks and not just wait to have a big pot of gold at the end of the year or the end of the 20 years. You put your money in there for 20 years. At the end of the 20 years, you're going to have a whole bunch of money. Well, what did you do for 20 years? Well, I saved up a whole bunch of money, so I'd have a whole bunch of money when I die. Well, that's great. What are you going to do with it? Give it to my kids. Well, what did you do for 20 years? I worked my ass off down at the local bistro, making as much money as I could and pumping it all into Tesla for 20 years so I'd have a big nest egg when I die. Okay, well, that makes a lot of sense. Well, I got to retire, right? I'm going to get old and they're going to take my job away and I need some UBI. So I got Social Security, but that's not enough. So I'm going to put some in Tesla so they'll give me money. Well, what if I want my money today and tomorrow and the next day? And every month I want to get a paycheck from Tesla. I don't want to wait until I'm 40 years old, 60 years old, 90 years old before I take my money. All right. I don't want to wait. I want it right now. Okay, well, put your money into this fund and they'll give you the money out every month as opposed to making you wait till the end of your life to get it. That's really what's happening, if you want to think it like that. Okay. So the chart is making money, but they're not saving it. They're giving it to you. So all along the way, they keep sending you the money that it makes. Does that make sense? That's why the distributions are so big. That's why you have 117% distribution. That's why you have 100% dividend. That's why you have 120, 82% dividend, because these markets are making so much money, but they're not saving it. They're giving it to you so you can go spend it and live off of it. So if you're interested in having income coming from the stock market every month, this is the way to do it. If you're interested in just having, $1 million at the end of your life saved away because Tesla went up $1 million over the time that you put money in there, great, do that. I'm not saying you have to do one or the other. You can do both. You can take money and put it into Tesla, because you can put money into Tesla and they'll give you money every month. Or then you can take the money, if you don't need it, you can put it into Tesla and grow it so you have a big nest egg at the end of the year, at the end of your life. Do both, do a combination. But that's what Tesla is doing, just so you understand. They are giving you the money along the way, which is why it doesn't show a big growth window. Now, if you want to see it, I've got something I'm going to show you. This is something we're working on. This is a software program that we're working on that's going to show this stuff, because nobody does this. We're going to have to come in and we're going to have to do this ourselves. So we're going to come in. Let me show you if I have Tesla in here. So this is Tesla right here. And see these two charts right here? We've done this. This is our software program. My son and I are working on this, and it'll be available to you, available soon. Right now, it's still in the distribution. We're still working on it. But watch, you can go, this is Tesla. This is Tesla. That's adjusted. So this is TSLY. TSLY. Sorry, I said that was Tesla. It's not. This is if you just do the dividends, okay? So that chart right there is the same as this chart right. Where did it go? Oh, it's still here. Just the same as, let's go do Tesla. Oh, right here. It's this blue line. See that blue line right there? That would be, oh my gosh, you are really bad at this, Lan. That would be, that blue line right there is represented in this blue line right here. Okay, but if you hit this little button right here, this, and let's turn off that. This line is Tesla if you reinvested your dividends, if you didn't take them out and spend them. This is what it would look like. All right. So if you start your dividend investment journey with Tesla and you just keep reinvesting your dividends, this is what that chart would look like. Now, if you look at them, both of them at the same time, they come out to be equal. They're the same number. So this line here is what Tesla would be giving you if you just reinvested your dividends, didn't take it out as money. But if you're going to do that, you can do that. There's nothing wrong with that. But you might as well just be in Tesla, in my opinion, because why are you taking dividends out, paying a guy a big old fee? You just will be in Tesla if you're trying to go for growth. Being in Tesla really is. I mean, you can do it, and there's nothing wrong with it, and I do it. I mean, I reinvest my dividends, and it compounds very nicely. But it's basically, that's not the point of what Tesla. These funds are designed for you to take your money out and go spend it and live off of it, right? Because they're giving you 116%. They're giving you Tesla 100% dividend yield. So that's why it's like that. So you can see both sides. And if you just want to see Tesla by itself, that's where it goes up. The NAV goes up, but not very much, because it goes from clear down here at 12 to 18 was the biggest move, right? Not very much. But that's because and the reason it comes back down is because the stock comes down. But then they're also giving you profits every month. Whatever profits they make by trading options on it, they give to you. I don't know. Maybe I beat that horse to death. Okay, hopefully you understand that. But this little program is going to be really cool when we get it done. It's just not ready yet. Not ready for prime time. Okay. So what it's going to do is it's going to replace this spreadsheet right here. Eventually, you're not going to have to do this spreadsheet because we're going to have that software program for you. But that is how you find out the yield on all of these. Okay. So we're going to come back over here to our cash cow portfolio. We're going to go to this one. Okay. So that's how we get the yield. That's what this whole first section is. All right. Now let's come and look at the next section, because the next section is the magic section. This section is where we figure out how much money we're going to make and how much payments we've received and how long before they give us all our money back. Now, remember, when you do this and you think about this, you need to think about it in a different way. It's not an investment that you're putting in there and it's going to grow. It's an investment that you've put in there and it's like a business. Okay. So you're giving them your money to trade. They're going to trade it for you. And what you want to know is the break even. How long before they give me all my money back? And then how much do I money I get after that? All right. So that's why I call them the cash cow, because once they've returned all your money, 100% of your money, then you no longer have any out of pocket risk, and everything after that is pure gravy. So I call it the gravy train, right? So we have cash cows and we have the gravy train. So this is very simple. We're just kind of, what day did you first put your money in? And in this case, we put in $50,000 on January 1st. And our payments received so far is $1,261. That's how much they've given us on our $50,000 investment, which is a dividend yield of 38%. Okay. If we come down here, this one is, let's come over here a little bit more. This one is Tesla, and we put $50,000 in Tesla on January 1st, and it pays out on day 27 every month a 99% dividend yield. So they're going to give us, they've given us so far $4,908. So how much do you need to live? If you needed $5,000 to live, basically what this is saying is just put $50,000 into Tesla and they will return you approximately 4,000. Is that for 1 month, or is that might be 2 months? I don't know. That's 1 month. So yeah, 1 month. So that's 1 month's return. 5,000. You can make it basically with a $50,000 investment. You're making about $5,000 a month in Tesla. Now, of course, that's going to go up and down a little bit based on how well Tesla does. If Tesla goes up, you'll make more. If Tesla goes down, you make less. But they're going to pay you out some of your own money, so they give that back. And you want that. You want your money back, right? Give me my money back. And so that's your remaining seed money. Well, we put in 50,000. They've given us 5,000. There's $45,000 left that they owe us. And then once am I on the gravy train? Well, I've still got $45,000 before I'm on the gravy train. Once this number here equals this number will go positive. This number you can just delete because they've given you all your money back. It'll go to zero. And then this number will go positive. I mean, if you just leave it in here, this one will go negative and this one will go positive. So there's no money, seed money. If you add more in, if you keep, well, you take that 5,000 and put it back in, make this 55,000. Well, you can do that. It'll just extend the payback years left. So now you got your gravy train. That's the gravy train. That's what that is. Okay. So it's just a math formula. You can see it up there, K12 minus J10. So K12, which is this number, minus J10, which is this number. So we're just subtracting this number from this number, and it gives us that number. So that's how we're doing this gravy train thing. So all we're doing is we're taking the investment, the dividends that they're giving us, dividends, ROCC, cash and capital, a combination of both, right? Which is why the line goes sideways instead of going up, because they're giving us our own money back. So once they return all of our own money plus whatever cash they've made. So you got cash and capital. Cash is the profit. Capital is the money you gave them. The reason the line doesn't go up like Tesla is because they're giving you back all the cash, which is your profit, plus the capital, which you gave them. So cash and capital. And once you get back to break even, everything for you is gravy. It's pure profit. Okay. They're giving you back 100% of your 50,000, and that's going to take 1.7 years. So in 1.7 years, they're going to basically double your money. It's not really doubling your money. They're giving you your own money back. Okay. So they're going to use it to grow their fund, and they can give you your money back and still pay you out after they've given you all your money back. You'll still get your dividends. You'll still get this money here. It's like being a founding member of their system, right? So you put your money in, they give you your money back, but they still pay you that money even after the thing is over. Just how it works. And so then you have your payback months left. We have 12 months left. Payback so far, they've paid 9.8% back. So that's a 9.8% return on your money in 1 month. That's pretty damn good. Not a lot of places do that. Again, if you go down to Cash Valley Bank, they're going to give you 4% in a year. And this came back at 9.8% in 1 month. I don't know very many places that you can go put your money and get that kind of return. That's a good return, 9.8% in a month. And that's what you live on. So you live on that. You're not going to have a big pot of gold when you die, though, because you're living on it. Now, if you don't need $5,000 a month, let's say you got 100,000. Well, they're going to give you basically $10,000 a month to live on. That's $100,000 a year on $100,000. And of course, it's going to go up and down a little bit. It's going to fluctuate, but basically that's what's going to happen. If you could save $100,000 and put it into TSLY, they're going to return to you about $10,000 a month. Now, let's say you only need $5,000 a month to live. Well, you got an extra $5,000. Now you can take that $5,000 and put it in something and grow it, so you do have a big pot of gold at the end of the year, at the end of your life. You could do that and to just live off the $5,000. I think it's a pretty good deal. I don't know. Some people don't like it, but that's because I think they don't understand it. They don't have a spreadsheet that tells them this information. Okay. They're trying to do it with their little iPhone apps, or they're trying to do it with even Track and Trade doesn't do this. So Track and Trade is very fancy, but it's designed for the old method. It's designed not to do this type of math. And so you have to have a spreadsheet to do it. And that's why the spreadsheets are a real pain in the butt. You have to do all this formulas and type all this shit in and come down here, and you have to enter in all the information as you get your dividends. You have to do the math, make sure it's all up to date. It's kind of a pain to track it. You don't have to track it. You can just put $100,000 into Tesla, and say, well, it's going to give me $10,000 a month, and you just live off of it and know that that's what it's going to do, and you just don't worry about it. But I like to track it. Okay, I like to know what's happening. So if you just want to be lazy, just go put it in there and just walk away. You can do that too. So that's what we got going here. So now this little box here is the estimator. So this is going to tell you, basically, because we know what the past performance is, right? We know, and we're not worried about the net asset value. We're not tracking the net asset value. We're just tracking the dividends, the money that they give us, the money we gave them. How much are they giving us back? How much have we give? How much is the profit? Well, that's what we're tracking, like a business. We're not tracking the net asset value of the business all the time. It's like when you rent a house. You're not constantly every day running around with your head like a chicken with your head cut off, worried about the net asset value of the house. You paid $200,000 for the house, and you're renting it for $1,000 a month. What more do you need to know? Oh, you want to know the value of the house over 10 years? Okay, that's fine. It's probably doubled in 10 years. So the house is now went from 200,000, right, to 400,000, probably because of inflation more than anything. The dollar value just went down. Your house didn't really go up in value. Inflation went up. So your house went down and needs more dollars to buy the same house, right? But anyway, nonetheless, that's, neither here nor there. You say the house is now worth 400,000, but you're still renting it for maybe $2,000 a month instead of $1,000 a month. But you don't run around with it like a chicken with your head cut off because the value of the house went up and down every day. And that's what we do in the stock market. Oh, Tesla's up. Oh, Tesla's down. Oh, Tesla's up. Oh, Tesla's down. Oh, Tesla's up. Oh, Tesla's down. That's running around like a chicken with your head cut off, worried that the value of the house is going up and down every day. Don't do that. It drives you crazy. Just forget about the value of the house. You don't really care about what that house value is. You're more interested in the rent and knowing that, eventually you're going to get all your money back from the rent. It's going to pay for the house. And then it's all one great big cash cow. Right? Well, that's the same thing we're doing here. We're just reproducing that in the market. So we got rent, and that's our dividends. And so it's a little bit more complicated that when you do the yield max funds, because they're not only just giving you rent and you have this value, which is going to grow at the end of the year, right? At the end of your lifetime, this is going to be doubled in value because they're actually taking some of the value of the house away. So at the end and giving it to you to live on, which is something that can't be done in the real estate industry. You can't sell part of your house every month and still get the rent on it. I guess you can if you use, the bank to loan against it, but then you have to pay them. Then you have to pay them interest. All right. So this is an estimation right here. This is an estimator. So this is going to tell you basically how much we think based on past performance. Past performance not necessarily indicative of future results, but it's the best we got, right? So we're going to look at what they paid in the past and make an estimate of how much we're going to get this month. So right here it says 3,522 is our estimate. Now last month it was 4,908. So they actually outperformed our estimate. So this is our weekly estimate, how much we're going to get every week. But we're not going to, this one only pays every month. So you don't actually get a weekly. It's just an estimate of what that would be, right? You're going to get paid every month. So 3,522 was our estimate. We got 4,908. So we were happy on that one. And then the annual income is just this multiplied by 12. That's where the mathematical calculation is wrong in your spreadsheet. So if you're using the calculator that I gave you and you haven't updated it, look at this formula in this column right here. The annual was not multiplying it by S6, it was multiplying it by R6 in some instances. So check to see to make sure your formula looks like this. It's got to be S6 times 12, not R6 times 12. So R6 was the weekly, and somehow I got that in there wrong, and that's your error. It's in this predictor calculator. So not all this stuff. This stuff was all right so far. I haven't found any bugs in it. But one of our students found that I had accidentally put in here R6, R times 12, which should have been 24 if I was going to do it off of that one, right? But it was wrong. So that's the formula. It needs to be S6 times 12, not R6 times 12. So make that adjustment on those, in this case, these 1, 2, 3, 4, 4 things. And then that'll get you your little projector calculator showing that we're going to make about $130,000 a year with this model. And what have we got? We got 50,000 here, 50,000 here, 56,000 here, 5,000 here. We've reinvested some of our money. That was started out at 50,000, and we've reinvested 6,311 from our dividends. And this one here, we did $499 from our dividends. So we're reinvesting our dividends back into the market to increase our monthly payout, right? So that's how. But we got what is it? So $150,000 is our investment. And now we're putting our own money back in. I mean, we're putting our dividends back in, or I hate to call them dividends because that's not what they are. Our distributions back into the market. So we get bigger distributions. It's called compounding. So far, we've got back payments received $10,000. We put most of it back into the market. 6,500. Some of it we went down and spent, right? We were playing the game. We went down. We bought some. We bought some things. We bought Land's pheasant hunting class. Arthur's not coming to the ranch. He didn't want to come. Ben's coming to the ranch. Travel, airline, $1,000. So we got some stuff. Bought the wife a present. So we spent some of the money, right? But we put some of it back in. So that's how this works. So that's the estimator. Now, if you come over here, this kind of takes it to the next level. This is the level that your little computer programmer, this little, your little app or track and trade is going to show you. This is that. And everybody wants to see it, so here it is. So what we're going to do is a cost of each share. This is how much you paid for the share. And this tells you how many shares we have right here. So we have to put this in. That's why it's in green. So we have we paid $19 for each share holding 2,630, and current equity in the business. So that if you multiply that out based on what the current price is that we figured out over here earlier, right? It's 47,800. So they've given us back 1,200. The NAV has gone down. So we show a total difference of $921. Now in the beginning, you'll see that if I put this in here, I said, look, when you first start out, this is the difference between what you invested or your seed money, today's business valuation of your share. So this is basically the value of your house, right, on the rental property. So it goes up and down, and right now it's down. So the invested seed money, today's business valuation of your shares, equity, and the payments you've received back, the loan payment, what we think as of overall profit and loss to date. Early in the venture, this number may be negative since the majority of the seed money has not yet been paid back yet, and the fluctuation of the investment comes primarily from the NAV, or the net asset value of the business itself, which might have fallen. Over time, this number should stabilize, be less volatile, and eventually turn positive and stay positive unless something very bad happens to the company we've invested in, and in that case, run for the Santa Monica Hills. All right. That was a reference to the fires. Get it? Funny. All right. Not funny. Okay. So that is what that is right there. So if you're investing into Tesla and Tesla goes out of business, well, that's a bad thing. You're going to probably lose your money. But if you have money in Tesla normal and not the yield max Tesla, you're going to probably lose money too, right? So you want to be in good stocks. You want to be in stocks that are rising in price. This is a rising in price market. If the market goes up, you make money. If the market goes down, you lose money, or you lose some money. You give some back, right? So we want the price, the markets that we buy into, we want them to go up, but it doesn't really hurt us that much if they don't go up because we're actually trading options and we still make money on the options if the market goes down. We just don't make max profit. So if you understand how a synthetic long with a covered call works, you understand that if the market goes up, you make a lot of money. If the market goes down, you just make a little bit of money. So, and you can lose some on the NAV, right? You lose it on the NAV. So if the market goes down and you bought it up here, well, you're going to lose some on the NAV, but they're going to keep paying you back anyway. And eventually it'll be a cash cow. And then it's all just no out of pocket worry anyway, and you're fine. So that's how it works. And so that's what this ends up being. That's just your equity in the business. So right now it shows that we're down $2,680 overall, but they've given us $10,000. But that $10,000 is taken into consideration here. Don't worry about it. They're going to give us another $10,000 next month, and then that'll only be down. We'll be up $8,000 above that, right? So that'll go up to 8,000 because they'll give us 10,000. But the NAV will go down because they're going to give it to us, and that'll be pulling out there. So we need the market to go up so we can have some NAV growth, which is why I always say we want to make sure we're entering the market and not to automatically reinvest your dividends. You want to be strategic about putting your dividends back in and just don't randomly throw them back in, because if you throw it in when the NAV's high, well, if the NAV falls, then that's going to show a negative number over here. Eventually it'll catch back up to you. It'll be okay, but nobody likes to have a big negative number on their spreadsheet. So just be wise about putting your money back in when you reinvest your dividends, or take it and spend it. That's what you're trying to do these for anyway. If you're trying to build up a big NAV golden, nest egg by the end of your lifetime, you shouldn't be trading these anyway. This is for people who want to live off their money along the way and aren't trying to save for a great big nest egg at the end of their life. They'd rather just live off it along the way, get a little bit of money every month. And that's what these are for, and that's how they work. Okay, now we're going to come down here. And now what I've done, if you notice, these are, oh, you know what? This table has not been updated, but this one has. So right here, see, that's just a number that you type in, but yet you enter in all of your seed money and your dividends in here. And I haven't updated this table to the new way. So this is our portfolio. And this one here, the cash cow portfolio model, the one you're using, has already been updated. So if this is the one you're using as a model, you can see that I've already come through here and I've redone these tables. So you can see up here, this is the dividends, and we should probably recolor these. Let's make these green so you can see that there's a real difference between the two. Let's make it really easy to tell. This is the money that's coming in, all right? So we're going to do that like that. And then let's make these white so that really kind of stands out that that's what we're doing here. So it's not, we don't get confused. These are our dividends. Okay. And then this is our seed money. So this is the money we put into the market. So you can see in here, we put 50,000, we put 50,000, we put 25,000, and we put 25,000. Now this is just a model. So this got all the formulas in there. We don't update this one. This is just the one you take, copy, paste, put it in there, and then you fill in your numbers. And then this is where you put in your dividends. Okay. So I put some in here just as models. And this is just kind of a model. And then these are your seed money. So these are dividends you've received. These are seed money. And then you're going to replace these with your real money, but the formulas are here for you. So now you can see that we got this as a green column. So you get to fill this in. And then the investment seed money is right here. And that number is not green, meaning you can't change it, which means it's a formula. And so it comes and it pulls from C51, which C51 is down here. And you can see that's this number right here. All right. So that C51 is your YMAG seed money. And however much money you reinvest your dividends in here, it'll keep increasing and it'll automatically update this column here. So your seed money will keep increasing if you put more in. Now, this payment received right here, this is also a formula. See, it's C34. So the C34 means you don't have to update anything up here in this upper table. Everything you update from this point on, once you have these green numbers in here and you got it all set, then all you have to do is just put in your dividends and your seed money. So if you got your seed money of 50,000, that's all you got in there. You don't have to worry about that ever again because that number is going to be right here. But then all you have to do is just every time you get your dividend, just enter it right here, and it'll reflect up here and update that whole table. The only thing you're going to want to do is you're going to want to make sure that your dividends that you're receiving are updated so that they're current. But if you don't care, once you're in there, you don't care. You got your money in there and you're going to get whatever they give you. So even if you didn't update that, you'd be like, well, whatever. It's just the numbers aren't exactly right. So I like to keep it up. I like to have a spreadsheet that's current. So I'll go through and I'll change those too. But nonetheless, you're just going to you can just put your numbers in here every time you get them, and it'll calculate how much money you've received, your seed money, all that kind of stuff. All right, so let's go back over here to this sheet. And I'm going to go do that. I will make this sheet for our YouTube channel. I'm going to go and I'm going to fix all these. So it's like the model. And I've done it on my real money account. I got like, on my real money one, I got like 7 accounts that I'm tracking. So it's a big deal. My spreadsheet's really big, and I can't wait for the automated system to do it for me. But right now, it's a big job to update these things. And so I haven't had a chance to do it on the YouTube portfolio, but I will. I'll get to it. I'll do that, try to get that done today. I don't teach my university classes this week. I'm off for the university. I don't teach for a couple more weeks. My classes don't start back up. So I'll have this week and next week to work on the spreadsheets for you. And I'll get that fixed up. All right, this update has been in there, not the colors. I haven't put the colors out there. I ought to do that and post this up there again. But the new spreadsheet is there with the changes for the error in the spreadsheet that we found. So that's your math error. Fix that on yours, then you don't have to update again. The problem is if you got all your stuff in there and you've been tracking it, and then I say, well, there's an error in the spreadsheet. Here's the new spreadsheet. That means you'd have to go put all your stuff in there again. So it's easier for you just to change your spreadsheet and get your math formulas fixed than it is to take the new spreadsheet. All right, there you go, guys. That's our math. That's our UBI. That's our UBI lesson. That's what we're doing over here with this these yield max funds, and that's how they work, and that's how our mathematics work in the spreadsheet. So pretty simple stuff when I really look at it. Oh, I got one more table over here that I haven't shown you. That's this one here. This is just kind of showing you what you're getting paid, and that's all that is. So I'm just saying in January, in this formula, is this the YouTube? Yeah. We got 1,261, we got 49 and 39. So we got $10,000 out of our account this in January. And I haven't done the February's yet. We've already been paid several times on a couple of these, at least on this one. I think we've been paid at least, I think, once on because that one pays every week. And so I got to come and put that in. But I pull these numbers. You can see I pull these numbers. These are formulas. So C36, and sometimes you have to, if you're going to do it every week, you got to do a sum of the one. So you can see right here, this is actually C36. So C36 is this number here. But that's because that's all January. I'm going to come in here and I'm going to put a February in there. So let's fix that. I'll show you how I'm going to do this. I'll take that number and I'll come back to home. Okay. So I'm going to take that number. I'm going to go equals, and I'm just going to add up the Januaries like this. And I'm going to hit auto. Actually, let's just do it like this. I'm going to come in here, reset that. Okay. I'm going to hit auto sum, and I'm going to auto sum these fields right here for YMAG. These are the dividends for January, and I'm going to hit enter, and that'll put that number there. Now you see it's a sum of those 4 numbers. Now I can put February in there, and it's not going to show up over here in this table in January's numbers, because January was pulling from here. But now I'm going to put a February number in there, and I want that number to be here. And I'll have 4 of them because it pays every week. So I'll add up those 4 columns as a sum and put it in February. And then that will be just pulling from these tables over here. But that's what this is showing. It's just showing you how much money we made in the first month. So that'll go out all the way till December, and we'll see we actually made, as opposed to this number here. So we can see how close we were. See, this is the estimate of how much we're going to make. So we're estimating $10,800. We actually only made $10,088. So we were off our guess, our best guess calculation was off by about $805 or something. So about $800 off. That's pretty good estimator. We estimated we're going to make 10,882 based on past performance, and we actually made 10,088. So that's a good guesser. So that's what we're going to guess again this year, this month. So for February, we're going to make the estimate. We're going to guess that we're going to make right around $10,000. We'll see. We'll see what it comes out to be, but it should be close. We were off by $800 this time, but hey, what's $800 amongst friends, right? All right, there we go, guys. That's my math. Do your math. And if this was like way over your head and I probably lost a bunch of people, well, just keep coming back and getting exposed to it over and over and over again. You can't learn everything in one day. I can show it to you in one day, just like we did, but it might be too much for you to comprehend in one day. Well, that means you have to just keep coming back to class. And that's why I just keep doing the labs over and over and over again. We just keep doing the same things over and over and over again. And you just, after a while, you know what I'm going to do. And so then it's not a question. You can do it too. All right. That's how it works. And I know it's working. I know it's working. And how do I know it's working? Because I'm doing it myself. I got a big portfolio and it's working for me. All right. That's it. That's all I got for you. I do have a Sunday school lesson if you guys want to stick around for it. I do want to just quickly tell you that we are using Track and Trade for the software program you saw me using over there to actually trade with. You can go get you a copy at trackandtrade.com. And we were using the stocks version over there. Tomorrow, we're going to be using the futures version at 2 o'clock in the afternoon. We're going to do some day trading in the futures market. That's going to be power hour. So join us tomorrow afternoon. Go get your software and you can follow along and trade along with us. It's a lot of fun. And I've got for you a Sunday school lesson. So here's your Sunday school lesson for the day. Don't be a jack of all trades. All right. And a master of none. Specialize in one or possibly two types of trading strategies. Consider short-term day trades and maybe some long-term options. Cover both your bases. Do what works for you. Just master one or two things. A lot of people get, when we trade, we have a term we call analysis paralysis, right? Have you heard of that? Analysis paralysis. People won't get in and trade because they can look at all their indicators and they draw their trend lines. They can see how every indicator will tell them the market could go up or it could go down. And so they won't take anything. They won't get in at all. So they get analysis paralysis. Well, people get analysis paralysis with the markets in other ways too, not just analyzing the market, but also like with these yield max funds. People won't put any money into this fund because they're worried that they could make more money somewhere else. And I'm always like, well, yes, you possibly could. I mean, this is pretty good money. I mean, you can't complain about 136% return or 74% return, 90. I don't know where you can get 98% return a year. That's pretty good money. But could you? Are there places that you can get better than that in the stock market? Yeah. I mean, there's stocks that'll double, triple, and go up 200-300% in a year. But you won't know that until after the fact, until the end of the year. So you just got to pick something and put your money in there. These are pretty good places. 98%. You can't complain about a 98% annualized return. And it's pretty consistent. I mean, it's coming in pretty close to that. I mean, it's up and down a little bit, but that's pretty consistent. That's what it's been doing over the last, you can see on this one here, 1, 2, 3, 4, 5, 6. Well, right there. The last 6 months on average, that's what it's been doing. So that's pretty good. It's not the perfect track record. It's not 400 years or, 14 years of track record, but 6 months, for the last 6 months, it's been doing 98%. Not a lot of places you can get a 98% return, but I might be able to get a 300% return, Lance. So I'm not putting my money in there. That's only 98% return. Okay, well, you're not going to know about that 300% return because there's thousands and thousands of stocks in the stock market. Thousands and thousands of stocks. How good of a picker are you? You think you're going to find the one that's going to go up 300, 400, 500%? You might think you can. But what if you pick the one that you think is going to go up 300%? It actually goes down 100% or drops by half, 50%, or drops by 20%. Well, then you sacrifice the 98% more than 10%. It doesn't mean this one's going to do 90. We don't know what it's going to do in the future, right? We don't know what any of them are going to do. But a lot of people won't do these because they're worried that they're going to miss out on the extra, 100% that they could have got if they threw the dart at the right balloon. If I threw my dart at that right balloon. But are you going to put $10,000 into that balloon? I don't $50,000. No, I'm going to put $1,000 into it because I don't really trust to go 500% up. Well, just pick something and do it, guys. Just do it. I mean, you get an analysis paralysis on picking your stocks. You won't do anything because you're just afraid you're going to miss out on the big one. Well, this is going to give you 98% return. It's going to give you your money every month. It's going to give you 10 grand every month with 100%. Do you need $10,000 a month? Probably not. You could probably live on 5 grand or 6 grand. Take the extra 4,000 and throw darts at 500% return markets. Do it that way. I don't know. I just think these yield max funds are pretty good if you track them properly and understand them. If you track them wrong and you don't understand them, well, then you have to join all the sheeple out on YouTube that are like, oh, these things suck. Okay, well, I don't care. I really don't care. All right, guys, that's all I got for you. Let's do something. Do something. All right? Something's better than nothing. Usually. Not really. Sometimes in the stock market it's not, is it? These are pretty good funds. I like them, and I'm investing in them, and I'm doing pretty well. So I just like to share what I do with you. I'm not telling you what to do. Do whatever you want. I don't care. I don't really care. Just sharing it with you. All right, guys. We will see you tomorrow. Power.